Earnings season continues to roll on. Markets responding accordingly. Here's what you need to know before the bell. So this week, of course, is the big kickoff of earnings season, as we've been talking about. And as we kind of get through the first week of earnings, so far estimates and earnings have been, well, kind of what you would expect. Beating lowered estimates. Everybody gets a trophy. But even companies that are missing estimates like Tesla, Netflix, stocks aren't going down a great deal, as that kind of bullish momentum in the market is really helping to keep supporting asset prices currently. And again, as we look at our chart of the S&P 500 index, we can see clearly this breakout of the downtrend line from last April. The market broke out of that, retested it, stayed above that line for several days, and then have now rallied from that over the last week or so, as earnings again have been coming in with meeting expectations. This is giving a little bit of fuel to the bulls right now, but importantly, as we're doing that, the buy signal that we talked about about 5 weeks ago is now getting fairly long in the tooth. It's beginning to narrow here. This suggests that, in the next week or two, we could see some additional weakness in the markets. This is kind of setting the market up here for a bit of a pullback. So again, thinking about if you've got trading positions on the books, maybe this is a good time to start kind of taking some of those positions off. Right now, real estate and financial stocks remain the most oversold relative to the S&P 500 and other sectors. And again, this is because of higher interest rates, because of concerns about the banks, et cetera. Those stocks have not rallied as much as other sectors of the markets. But when we're talking about absolute performance relative to each of the other sectors, a little bit of a different picture emerges. Energy, healthcare, utilities, technology, obviously, which have been the big winners as of late, communications and staples are overbought relative to financials and real estate. Transportation, which has been under pressure here because of expectations of kind of weaker economic growth. Materials, consumer discretionary, obviously a weaker consumer. This is much more of the story on an absolute performance basis about expectations of the economy. A disinflationary, slower growth environment, good for companies that have the ability to grow earnings. Obviously, technology and communications and staples fall into that category. Again, during a recession, people are still going to watch television. They're still going to get on the internet. They're still going to use technology. They're still going to go buy, toilet paper, water, those type of things at the store. So not surprising that these stocks have been performing better in expectation of a weaker disinflationary environment. Stocks that are more sensitive to disinflation, real estate, utilities, financials, those have been under more pressure. But what this does tell us, though, is that during a rotation in the markets, if we begin to see a sell-off in the markets, a correction back, we should see money potentially rotate from the sectors that are most overbought to some of the most oversold sectors because of just simply that rotation from risk to safety. And again, when you start thinking about where the market may move to next, and particularly as we get through earnings season, we still haven't resolved a lot of the economic concerns at this point. Weaker break-even inflation rates, weaker economic statistics, and of course, the Fed still continuing to hike rates. Again, Fed now expected to hike rates by 25 basis points in May. More pressure on the economy. So again, not surprising. We may see some rotation here near term, but again, longer term, the concern is going to be ultimately for a weaker environment. So again, think about taking some profits in areas that are really overbought and raise a little bit of cash here near term, potentially for a bit of a market pullback. I'm your host, Lance Roberts, and that's what you need to know before the bell.